So good morning, everybody, and welcome to another episode of How to Invest in Cannabis. I'm your host, Jordan Youkilis, one of the founding partners of Key Investment Partners. Today, it is my great pleasure to have Cato Felan here with us, the founder of Hoja Capital. Cato, thanks so much for joining me today.
Hey, Jordan, thank you very much. I'm happy to be here.
Fantastic. So Cato, just to kick things off, would love if you would take a little bit of time to talk about what Hoja Capital is, and then we can kind of dive into your background from the get-go.
Absolutely. So Hoja Capital Management is our investment firm that is working to provide different kinds of access to alternative investments, more kind of democratized access. And so our first foray into that is in the cannabis space and building the first kind of multi-manager investment fund in cannabis. Fantastic.
And but before we get into your decision to get into the cannabis industry, would love to learn a little bit more about your background, and can you talk about your undergrad and how your career path transgressed from there?
Sure. So in college at the University of Texas, I had kind of two main areas of focus and passion that I followed, and one was politics. And so I was on the student association. I volunteered at local mayoral campaigns, and I finally also volunteered for Governor Ann Richards' campaign near the end of my tenure at University of Texas. And then kind of academically, I was always very interested in Latin America history, economics, the whole, shift from some of the dictators that they've had and the movement into democracy and just how that all played out. And it's just something I was always very interested in. And so those were my two big passions as I left college, and I stayed on with the political campaign and started working with the consultant for Ann Richards' firm called McKinnon Media. And we did TV, radio, speeches, political candidates across the Southwest, Democratic candidates across the Southwest. And Governor Richards was one of our clients. Mayor Bob Lanier was one of our clients, and a bunch of other congressional and Senate candidates. And from there, I took that to Washington, D.C. After Clinton got elected, and I was just trying to figure out, what the political realm had for me. I worked not on Capitol Hill, but on K Street, worked for a lobby and public affairs firm there. Mm-hmm. But the politics industry was just, I couldn't get my arms around kind of, just lack of a better word, kind of the hypocrisy and kind of two-faced nature of it. I met a lot of wonderful people that I became great friends with on both sides of the political aisle. But too often that, when you saw those folks in their public life, they were very different than they were in their private life. And I just couldn't really reconcile that. I'm only one person, my one true self. And so I couldn't really reconcile that. So I needed to figure out a way to get out of politics and get into Latin America. And so that's when I kind of, 1994 is when I kind of made a break with politics. And while I'm still involved and engaged in politics, I'm a political junkie. I mean, I read everything that's out there, especially during the campaign years. And so I still follow that, but I needed to kind of figure out a way to get in Latin America from a business perspective and a career perspective. I felt that was a better path for me. And so I decided to kind of just jump in, and I interviewed. I was in DC at the time, so I interviewed with a bunch of different firms that had lobbying or public affairs contracts with the government of Mexico or the government of Venezuela and things like that. And one of the firms, a firm called Burson Marsteller, which has been merged and acquired a number of different times at the time, but at that time was the largest public relations firm in the industry. And I had interviewed to go down to Mexico City. They had recently been part of that whole NAFTA push to get NAFTA finalized and agreed to, and it worked. And so I wanted to kind of get into Latin America through that avenue. But there really wasn't anything. That was still kind of disjointed and decentralized, and there wasn't an opportunity for me there. And so they actually hired me to go to Los Angeles because they needed somebody with a political background that had ties to kind of Hispanic community to do a lot of work there for their corporate clients on the public affairs side. So I did that for a few months. It was kind of like my vacation in LA for about 8 months until I transferred with that same company to Miami to work for the president for Latin America and kind of be chief of staff for all the offices in the region. Wow. And that's really kind of got me into Latin America. It was a great time. I traveled all over Latin America. I lived in Buenos Aires. I lived in Lima. I did a lot of time in Sao Paulo and Rio. And so I really enjoyed that entry because it was just everything I really wanted to do, working with really important clients, big names like Ford and Citibank and Fidelity Investments. So that was a great foray. And then when I really got deeper into financial services was when Fidelity Investments was one of my clients. I helped them open their institutional offices in Argentina, Brazil, and Chile. We helped them meet with regulators. We helped, meet with potential clients, pension funds, and the like. And I met a lot of the senior folks on that very large road trip that we did through those countries. And a position came open for a wholesaling job, which I had no idea what a wholesaler was at that time. But to come in and be based out of Miami, but to cover and travel to Mexico, Ecuador, Peru, Colombia, Venezuela, Panama, and sell mutual funds that were offshore mutual funds that had their jurisdiction in Dublin, but they were still managed by the Boston-based firm of Fidelity Investments that I was at, and sell those to banks, brokerage houses, advisors in Latin America, and to their high net worth clients. So that was a wonderful experience in that I did a lot of road shows. I did a lot of education on global financial markets, on what are mutual funds, how to invest in mutual funds. And I did cities big and small all over Latin America doing that. And it was a really rewarding and fulfilling experience at the time to be able to do that. That I did that for about four and a half years. And then there was some kind of reorg changes and they wanted me to move into Latin America, but I wasn't really into that. And so that's when I joined Putnam Investments in 2001. And that time I was the domestic wholesaler, but I was in Miami. And if you're not in Miami, if you're not doing Latin America offshore business in Miami, you really can't ever get that big or that relevant because it's a big international market and a big hub for financial folks from Latin America to come through. And so I did that for about a good 7.5 years. And that was a great experience from the sales side. I mean, that organization was just a beautiful selling machine, maybe not so great on the investment management side, because I had some really, really rough years of performance when I joined that place. I joined in 2001. And it was just as the .com was unraveling, and that firm, a number of the funds had loaded up on technology and internet stocks and the like. So they wrote it up and they wrote it all the way down. And I came in to really kind of pick up the pieces in my territory and kind of rebuild that back. So that was a great lesson. It just, perseverance. I mean, there was lots of times people did not want to see me, and not me personally, but, my firm had just had this big, we were on headlines in 2004, 2005. Our name was all over the financial press and local press, and it was really hard getting a meeting. But I just kept showing up, and that really kind of set the tone for my career here in Miami. And the fact that even when things were bad, I was still a trusted resource and a person that people could know that I was going to had integrity and honesty around everything that I was doing. And so I think that really made my career. I mean, before that, I was doing fine and doing well, but that really kind of distinguished me in the sense that, I had to keep showing up. I had to keep delivering and had to find ways to be relevant to folks, when the company I was with wasn't as relevant to them at all. And so that was my kind of Fidelity and Putnam were like my active mutual fund life. And then in September 2008, the greatest serendipity of all time to join iShares to build out their offshore ETF business. They'd had a presence in Mexico, building ETFs that trade on the local Mexican exchange. But I was brought in to really work on US-based advisors that manage money for Latin America clients and help them increase the utilization of ETFs. And so not just the ETFs that trade on New York exchanges, but the ones that trade on the London exchanges and other exchanges around the world that provide better tax advantages for offshore investors. And that's when I really just kind of jumped into the passive way of life. I really felt like over time, the statistics show that, on the mutual fund side, active mutual funds underperform by their fees. And that's just kind of what it is. And so I felt like the index and passive way was a better way and a better product for my advisors. And I also wanted to join a firm with a lot of integrity as well, too. Not that Putnam didn't have integrity, but there were parts of it that were, they made my life really hard for several years. Nothing I did, but really what was going on at the firm level. And so I really enjoyed kind of the ethos around iShares, and it extended from the product and the transparency of ETFs to the overall culture of the firm. And we had a lot of great vision and values about, speaking the truth and about integrity in your work. And it's not just about results, but how you get the results as well, and about collaboration. So it really infused in me a kind of a much more teamwork approach rather than the lone wolf that I'd been used to. You kind of eat what you kill on the sales side. And so that really made a big shift for me. And I was already kind of thinking about, passive in that way and index in that way. And then joining ETF, iShares in the ETF world at that specific time was just, the universe saying, hey, it's a good move. That quarter, the final quarter of 2008, iShares had $100 million in inflows, which was at that time the kind of the biggest quarter of inflows that anybody had ever had. Obviously now it's so much bigger, but that was a big deal because it was a financial crisis. People were moving out of individual stocks, coming into ETFs and just that basket. And so it really shook the world. And that was really a big kind of a tipping point as far as active to index and passive. And now passive is recently, I think just last year, surpassed the assets in active, and it's still growing. It's still growing like crazy. And so, I that was a great time. I did a lot of great things in that world, in that space. I worked very closely with a lot of the major firms like Credit Suisse and Merrill Lynch and UBS and Morgan Stanley to really build out these types of platforms that really gave broader access to these offshore ETFs to their client community, the wealth management community. Heretofore had been used by a lot of institutions, and wealth managers were really starting to use it, but they didn't really understand what these products were. And so it was a real educational experience for them and me, really learning how people are using these things. But the challenge for me on that one, just also from a philosophical perspective, was the fact that, I knew that in the active side, portfolio managers were underperforming by their fees, and no one's really smarter than the market. Okay, so that was kind of a given there. But then when you move to the ETF side, the product was better, but we were putting the entire onus on the advisor, broker, or banker to build a portfolio for those clients with those products. And I just couldn't really reconcile the fact that, here before at the active manager side, you had, Harvard, Stanford, Wharton MBAs that all they did was run money. 100% of their time had a massive team of analysts, and those guys still underperformed. And so I just couldn't reconcile, from just an investment standpoint, that an advisor who has relationship management duties, bringing in clients, managing their practice, investment management, getting new clients. There's a whole lot of things that they're doing on a daily basis. And I just couldn't reconcile with the fact that we were giving them these wonderful tools, but they had to figure out how to put them together in the right way for their clients to give them a better investment experience. And I couldn't reconcile that. I felt good about my products, but I really felt like when I handed it off to somebody else, I didn't know if that was the best thing for their clients. So I needed to find, my goal was just to try to find a better way for people to have a better investment experience and things that they just don't know about. And so that got me to Dimensional Fund Advisors, who has a very rigorous process about how they invest, but also an investment theory and philosophy around that markets work and markets are efficient, coming out of Gene Fama's work and Ken French's work on markets. And so, that really spoke to me. It really spoke to me, the fact that, hey, in these markets, no one's smarter than the market. There is wisdom in crowds, and everybody's making a trade with their own information. And, over the years with Reg FD and with decimalization, there's very little asymmetrical information that's happening in the capital markets and the public markets. And so everybody that makes a trade, when it's on the way up or on the way down, they think they're making a good trade. And so that also kind of spoke to me. It's like, all right, so if markets work and markets are efficient, how do we extract performance out of the markets? And so it just made so much sense to me when I got to Dimensional, and then really dug deep into, the complexity of it. But as a simple formula is that, equity outperforms debt, small outperforms large, and value outperforms growth. I mean, that to me was it's like the Pythagorean theorem, A squared plus B squared plus C squared. I mean, it's just so simple to me, but yet you could do so much with that. And so that really appealed to me, and I really enjoyed my time at Dimensional. It was a great time of thought leadership for me, a great time of really expanding kind of the way I thought about markets and how to invest. Yeah, and so I really enjoyed that too. Yeah, that was a great foray into what I was doing. But then I was also, at that time, personally, I was going through a divorce. I needed to get back to Miami. My kids were living in Miami. I was living in Austin, Texas, and I was going back and forth. And so I needed to figure out a way to get back to Miami. But I didn't want to go to any other firm. I really felt with Dimensional and iShares that I was working at the best places I could find. And I knew a lot of people in the financial industry. I knew, I could go, I felt like I could, find a place anywhere I wanted to, but there wasn't anywhere I wanted to go. And, I was also, looking at, what the next phase, the next 20 years of my career were going to be. At this time, I think I was like 45, 46 as I was kind of thinking through these things. And, if you look at the capital markets landscape from mutual funds and ETFs, 2/3 of every dollar go into Vanguard and BlackRock, and everybody else is fighting for a smaller shrinking piece of the pie on the public side. So I like to play in markets that are flowing, that are growing. That's where I want to go. I don't really like to play in shrinking markets. I think it's really hard to make money in that and do good. And so I said, well, let's look at kind of alternative and private equity. And if you look at over time, over the last 20 years, the slice of alternative investments in institutional and wealth management has grown from less than 5% to almost 20%. So that was a steady piece of growth that I could really kind of get involved with. And if you look at total private markets now globally, it's about $7.3 trillion, which is about half of what the wealth management industry is in the US, about $15-16 trillion. So, I felt like, hey, that's growing. That's a space that I could, compete in. But nobody was going to take a flyer on a guy who wants to come in as managing partner who's never done a thing in private equity. I had to go out and figure out my own way in that space. And the best way I know how to do that is kind of join kind of frontier and emerging markets. And that can be kind of geographically or sector or industry. And so I looked at crypto and I looked at cannabis. But I've just been in investment management for so long, determination of price is very important. It's very important to understand if you're getting a good price or a bad price when you make an investment. Is it cheap? Is it oversubscribed? Is it expensive? What is that? And I really couldn't figure out, maybe it's just on me, the pricing on crypto. You look at some of the Dogecoin stuff, they're printing new coin every single day to infinity. So how do you set a price when you have infinite supply? Those kinds of things I couldn't really get my arms around. But in cannabis, you could. There's real fundamentals here. There's real products, real people that are doing this stuff. And so I felt like I could create an investment case for cannabis. I just needed to figure out what that was. I was living in Texas. Cannabis in Texas is very small. It's not growing. It hasn't really grown. There's a lot of great innovators there, but you really have to leave to really make your mark, and you have to go to international markets to do that, or other markets to do that. So my partner and I, Meredith Yarbrough, and I, we had actually been talking about this for about 6 or 7 months, about going into cannabis and starting a venture together as I was leaving Dimensional. And then, April 2018, time is now, let's go. I had just left Dimensional, and we're trying to figure out what we're going to do. I said, all right, the time is now. We got to get out of Texas and figure out what's going on in the space. So we just loaded up my SUV and did like a 6-week road trip through California, Oregon, Washington, up into Toronto, back down through Nevada and Colorado, and then back into Texas, meeting everybody we could in the space. I'd had a lot of friends that moved over from financial services into cannabis, and also some friends from college who were doing some legal work in cannabis. So I had a small network that I could build off of, and then it just blew up and grew. The first week we had 4 or 5 meetings. Every week thereafter, we had more and more meetings and lunches and dinners and just meeting the whole industry, VCs and private equity, investment bankers, growers, and the like, and just trying to figure out, what is this space? What is seed to sale? What's a terpene? All those things that you got to learn about cannabis, And so then we just took off and we got into it and started building. So that was from UT to there.
Yeah. Wow, that's fantastic. So it sounds like a recurring theme in your career decisions have been really on targeting industries where you see a lot of growth, right? Be that moving from active management to passive on the public side, and then getting into the private side, finding a rapidly growing industry like cannabis that also suffered from capital constraints.
Sure, absolutely. Yeah, that's absolutely been the case. It's one of those things where I've never been comfortable being comfortable. I thrive, not so much in chaos, but in growth and change. That's really my MO. That's what I enjoy doing. I take a lot of bows and arrows coming at me being on the frontier, but I enjoy that. I enjoy, really figuring things out. And I got to tell you, it's a lot easier now at 51 than it was when I was, 21 and 31.
Sure, sure. And it sounds too like, I think it's really great that you're emphasizing the importance of value and price, right? Because I think, especially in emerging sectors, and as we've seen with, a lot of the Reddit traders and momentum traders, that people are starting to lose that price sensitivity and are willing to pay for growth at any cost. And I think especially in cannabis and other emerging sectors, it's important to say, hey, there still needs to be some fundamental analysis here. You really need to understand what the intrinsic value of this asset looks like.
Absolutely. And there's some great people doing that. There's some great people like you guys and other managers out there that are doing this, that, that is crucial. That's crucial to really understanding, what you're investing in. And I just felt like there was a way to kind of harness that expertise in the industry and really, work with and provide support and overall resources to the industry doing that. That is not my forte. Individual kind of, discounted cash flow analysis and those kinds of things. That's really not my forte. Structure is really my forte. I'm not trying to say, hey, I'm smarter than everybody else, but I can tell you that building the structure to capture the returns of the industry, I absolutely am able to do that.
Absolutely. Well, I think that's a great segue to explain a little bit more about what exactly is a fund of funds. What does that structure look like, and what are some of the pros and cons of the fund of funds structure versus directly investing in specific companies or with a single investment manager?
Absolutely. Well, funds of funds have been around quite a while, and it's a relevant philosophy for lots of investors that want to get broad access to private equity or private debt or just private markets. And in the broader market, it's absolutely needed because you or I or anybody else that has not been an LP at Sequoia or Benchmark, you're just not getting in on any deals. You're just not. You're so far removed from getting access to that a fund of funds is really generally the way that most people get access. The late kind of high wealth management folks to get access to that. And so in cannabis, as we were getting into the space, we worked for some farmers in Humboldt County, helping them, transition from illegal to legal and writing business plans and modeling for them and things like that, just to really learn the industry. I mean, that was a loss leader. We put a lot of time and resources into that, and it was really just to learn. That was really our R&D in the space. And then we started, and from that you could see, kind of who was investing, who was buying, what kinds of folks were making these investments inside the space. Yet outside the space, I kept hearing people like, man, I'd love to get access to cannabis. I just don't know how, and I don't know a way to get there. At that time in 2018, I think there were like 3 ETFs at that point. Even there's more now, but there was only a few then. There was only still less than 20 publicly traded stocks on the Canadian and the New York exchanges. Maybe 5 with any volume. So there wasn't a lot of public ways to kind of get access to it. And the only way to get access on the direct side is if a deal hit your desk. And you never know why a deal hit your desk, but hey, I got a deal in front of my desk. And most of the people that come into cannabis that get a deal on their desk, it's usually a dispensary or a grow or extraction, something like that. That's really limited. That's really how kind of lay persons outside of cannabis view cannabis, that those are the investment opportunities. You got to get a license. That's the way to make money in cannabis. Well, the reality is different, and so there's different metrics around that, and there's different returns you get from that. And so it was really just trying to understand, where the returns are coming from now, where we think they will be coming from, and how do we manage kind of that risk and volatility. I really feel like cannabis is a great place for private markets because you're not creating a market, I'll give you an example, like a Facebook or an Amazon, things like that. Those are things that did not exist before and nobody had ever figured out. Nobody said, oh, we don't, it's like an iPhone. I don't need to know I need an iPhone until I got an iPhone, And so in cannabis, you're really converting this kind of ready market to kind of this legal market and giving people access to it. And you're bringing in more people, absolutely. But there's already a ready market that people that want access to this space and really will try almost everything just to see what's going on in that space. So it's a little different. And I really believe that that innovators, inventors, creators, entrepreneurs, that everybody should create a cannabis type business, whether it's B2B, B2C, direct to consumer, whatever it is, because one, you're going to get in front of VCs. You just will. You wouldn't do that if you started a new AI company and try to go up Sand Hill Road. You're just not going to do that. It's not going to happen. You will in cannabis. You also have a ready market that's available for you, that people will try it. You're going to get a shot at it. This is like, starting your company in an emerging market, but you're doing it is for not geographically, but sector-wise. And so I think there's a lot of opportunity there. But what I saw is that it was either you're going to be a canna-billionaire, you're going to lose all your money in individual deals. And then on the fund deals, you get max 10 to 15 names that you get in a portfolio. There's some out there that have 50 names, things like that, a different kind of model. But for the most part, it's 10 to 15 names you get in a portfolio. And so, as I thought about kind of the .com era, even into 2000 or 2001, AOL and Netscape were huge. Those were massive names. Like, man, those are going to be around forever. I knew people that made 2,000% on AOL. Like, man, this is the greatest thing ever. And you think about those things now, like they're afterthoughts, people, they're discarding. AOL just basically got discarded in a deal that just happened. It was like an afterthought of what's going on. And so I really believe like those, the next, whatever big brand name, we haven't even found it again. It's not even, it may be there now, but it may not be. And so what I thought is like, well, if I was back in 99 and 2000, if I could find a way to just kind of harness all these companies, all the returns we're getting, and not, bet on this one area, one sector, one place, that I think that could work. And so how do I build something that has diversification, that puts me, if the risk is over here, for one company, and so I want to be over here, that provides diversification, risk management, volatility management, and gives people, allows them to sleep at night while they're having their investment, create a better investment path for them from, initial investment to exit. So how do you do that? And how do you get 100, 150 names in a portfolio? Well, to do that directly, it's a big undertaking. It's a big team. It's a lot of capital. It's a lot of work, a lot of underwriting. It's a lot of stuff. And so the way to get to market kind of quicker in that was through a fund of funds. There was enough, I felt there was enough scale in the cannabis space to be able to do that. Luckily, we found that there is plenty of scale. There's plenty of great investors in the space and coming into the space that we could really build out a robust offering that is diversified by debt and equity, diversified by sector, state, and lead investor to give kind of a range of returns and really allow you to kind of just capture the market that's growing at 25 to 30% a year. And we'll see what happens at the end. But within this portfolio, you'll be able to kind of double down on any co-investments that come out of it. And so, I think it was a way for people to kind of get access to cannabis that they didn't have to make a bet on any one area, and allowed them to kind of get more exposure if they so chose through co-investments.
That makes total sense. And, I think a couple of things I'd highlight, you mentioned the comparison versus crypto and other emerging sectors. And we draw that comparison all the time as well, right? Because of course, it's clear at this point that blockchain protocol is going to have massive applications, that there's certainly going to be a space in the future for cryptocurrencies, but you don't know what is the intrinsic value of those currencies. Is it going to be Bitcoin wins it all? Is there going to be some upstart one like Dogecoin that no one saw coming, right? It's much more of a pie in the sky, I think, equation, right? Versus in cannabis, you already know you've got, call it $100 billion of black market demand. So it's very much just about what are the companies that are going to transition that demand from the black markets to the legal markets.
Absolutely. I agree.
Yeah. And I think the co-investment model makes so much sense too, right? I mean, from before Key Investment Partners came from Partners Group, which, started really very much as a fund of funds themselves, then got into secondary fund investment, then co-investments. And that was really the strategy they pursued, was really, how do we find solutions for our clients and get them the diversified private markets exposure that they're really looking for?
Absolutely. I've read the Harvard case study on partners, and
sure.
It appeals to me directly. We had these great fund fellows work with us, and so I got to see a lot of the case studies there. And I read the partner was one with great intent. I really appreciated the thoughtfulness that partners had as they built out their firm, and then the crucial decision to go public. That's
Right.
one of those things that it comes about out of more, that seemed like a lot of times comes out of more circumstance. I really believe that if your goal is to go public, you're going to, anytime that's kind of your goal, you're going to do everything you can to kind of get there. But if your goal is to create a better investment solution for your LPs, and then you're going to go public because you've got to handle some things around the business to ensure that you're able to deliver that, I like that model. I like that model a lot because it's intentional, it's deliberate. It's really one of those ways that your intention is to provide the best returns and best experience for your LPs, rather than, hey, how do I go public as quickly as I can? And so I really like that model. And like I said, I've studied it quite a bit, and it plays into kind of the model we have for growth, series of fund of funds, some direct funds and things like that as we go forward.
That's great. So then kind of following that path a little bit, how did you develop the specific theses at La Hoja Capital? What are some of the types of funds that you're looking to invest into?
Yeah. So we made a couple of decisions early on that I think are pretty solid. We'll see. You never know. We'll see how they play out. But we wanted to be a U.S. only fund for the first one. There's a lot of great things going on internationally, but the U.S. is the one we know the most and we know the best. And until I do another roadshow across Europe and Asia and Latin America to see all the businesses there, then we'll expand that out. But we felt U.S. was the way to go. We also wanted to do privates only. Public investments have had a nice run at the end of Q4 last year and kind of the start of this year, but there's just so much volatility and noise around that space right now, and especially with where we are in the broader markets, we're in a period of high excess, and a lot of volatility. And so I just didn't want to invite that in for this first fund. It's a 10-year fund. And, we've had great public market performance over the last 10, 20 years. I just don't know if that's going to be the same over the next 10 to 20, especially at the prices we are now. It's just kind of math. And so those were two very big decisions that we did. The third decision we made was that we were mainly going to invest in fund 2 and up, or if you put capital to work the prior 18 months. We just needed people to have experience investing in cannabis, because as we were doing our research, we found a lot of zombie funds that maybe started to raise 2017 or 18, most likely 2018, and then 2019, the market kind of shifted. They never finished their raise, or they got a few investments and then trouble hit, and they didn't have the experience to kind of do any workouts with those things. And so, I believe risk and reward are related. We don't know exactly how. And so all the early investors that made it through took the risk and were rewarded. They've had great IRRs. They've had some great exits and things like that. But that they took the risk to kind of enter this crazy market early on. Now, while from the outside it still looks like the Wild West, when you're in it, there's real fundamentals here. There's real fundamentals of each business that you're looking at. There's real structure. There's real management teams that are in this and real products that are getting done. And so I think the risk return ratio is a little different now. I think there's still tremendous upside to be had. But I think you have to be more judicious about what you're doing, rather than just kind of throwing a bunch of things at the wall and see what sticks. So we wanted to make sure that we had folks that were seasoned investors. So if they had a pedigree, like you guys from Partners or others from Carlyle, or ran their own hedge funds or credit funds, we needed to have some real investors in the space that would allow us to just kind of piggyback on their success. And so we just really, I felt like we were stacking the deck in our favor for success. U.S. only, the biggest market so far. Privates only. I think that's going to reduce a lot of the noise from the outside public markets. And then fund 2 and up. Seasoned investors that had convinced, had returns to convince LPs to re-up to go for a second fund or a third fund. And so those were the key decisions that we made early on. And then we just started doing research on every single fund in the space to really, round that out and really figure out if our premise and our thesis was sound, and so I try not to have kind of like selection bias. I really want to be as agnostic as possible to the things that I do, because as I said, I'm not the star manager. The structure is the star, and so I want to make sure that I'm being as agnostic as possible to the opportunities while I'm managing the overall risk of the portfolio. And so I felt those kind of decisions would really kind of stack the deck in our favor for success. And if I structure it right, where it's diversified, we put capital where we believe returns are going to come from in the short term, medium, and long term, and then structure it across, diversified across state, sector, and lead investor. I thought that was a pretty good premise. And I think it's a premise that a lot of people could understand and could figure out as they make their foray into investing in cannabis.
Yeah, no, that premise makes total sense. And I think it's also really smart of you guys to stay so focused on where you are spending time and where you're not spending time, right? And I think one of the issues or mistakes, I'd say, we've seen some investors in the space fall into is that they suffer from strategy drift, right? Because the longer you're in the cannabis space, the more opportunities you see, right? As you mentioned, I mean, Europe, there's tons of opportunities, Latin America, of course, as well. There's stuff on the real estate side, stuff in the public markets. And so it can be very easy to suffer from shiny object syndrome, right? But you really do want to stay focused on what is your core strategy, know every in and out about that specific space, and then pick, these are the ones that we think are really going to be the leaders here longer term.
Oh, that makes all the sense in the world, Jordan, because as we've seen, right now, there's a lot of bright, shiny objects. There's a lot of really great companies in cannabis that have gone through a Series A and are maybe going through a Series B or C, but are, 1 or 2 rounds away from a big exit. And that's where a lot of money is coming. A lot of new funds are coming through there. A lot of old funds are adding that to their overall portfolios. And, there are thousands of companies in cannabis in the US. I mean, thousands, and new ones pop up every day, and every new market that comes in, who knows how many new companies are going to pop up out of New York and New Jersey area. I mean, that's just huge. And so I think it's one of those areas where, capital is still constrained. And so if you can show, hey, look, these are the types of companies that I'm investing in, and like people can heard those names, or I can look them up and see who they are, it makes it easier to kind of raise the capital in that sense. But from an investment standpoint, it's really pushing a lot of the capital towards those few names, 10 names that are getting, 10 to 20 names that are getting all the capital right now, and pushing valuations higher. And, I just think that, there's still, if people are in the seed and late seed and kind of early stages of private equity, you're still getting things that, 1 to 1.5 times revenue. And then you go to kind of this other names, those multiples are much higher, they're much bigger, and they're trying their value. And because we had this big run up in the capital markets, in the public capital markets, using those valuations to justify some of the valuations in the private space. And they're really not linked, they're just really not linked right now, because there is such a delinking from reality in the public markets now overall. And so to kind of extrapolate that to what real businesses are doing in the cannabis space and growing revenues, increasing margins and things like that, I don't know if they actually equate when you're making kind of a comp-based analysis like that. Yeah,
no, that's something that we try to stay really focused on as well, because again, I mean, to kind of what we've been talking about, some of these top performing market leading assets have also gotten pretty high valuations, and not to specifically name anything, but it does seem like there's certainly a risk of folks chasing these big names, and also with the influx of SPAC capital, that almost inherently the SPAC transactions can force the SPACs to overpay for a business, just because there's not enough cannabis companies of size to justify the SPAC acquisition. So it's definitely an interesting dynamic that you see going on in the market.
Yeah, I mean, you see some of these SPACs out there that, just massive numbers. I mean, how many cannabis companies could you buy with that? If you go away from the one that kind of that mid tier that are not public, but that are, really large size MSOs and things like that. With $1 billion fund, you could buy a whole chunk of them, the SPAC. But, I don't know if that's really all that I don't really know if that's a good long-term, future for those companies. I mean, look, I think SPACs are great for the sponsor. I think if you look at returns for SPACs over the last 20 years, I think every single, this is a generalization, but I've seen just a number of reports. I think every single one of them is negative, or lower than their initial offering, So I think there is a route to public markets that is kind of well worn and works. You go on a roadshow, you do your S1s, you get all kinds of scrutiny on what you're doing. And if it's true and real, then it gets done. And sure, there's a lot of companies that go public that aren't doing well, and whatever, it's good bad management alike. But I think if you kind of circumvent that route, where you're only having one sponsor, one person, one group, one team look at it. No matter how great and wonderful they are, no one's smarter than the overall market. They're just not.
Sure. Yeah. And I think as we started getting smart on the SPAC market, one question we asked is this going to be a similar transition like you saw with active ETFs move into passive ETFs? Are SPACs just a better structure than the traditional closed-end illiquid fund? And I think there certainly are elements of SPACs that are very attractive. I mean, obviously the liquidity is a huge bonus to it, but to your point, I think there's also a lot of issues with the structure as well that we're still sorting through and will be happening over the next several years.
Yeah, I think so too. And I think there's a number of, I think, Harvard and Booth both have some really great thought pieces on SPACs and looking at performance of SPACs and the things like that. And so, there's a place for everything. We just made some decisions early on in this fund that we wouldn't include those kind of public vehicles. We've been asked to jump in on a number of those things. And, while I think it would have been great for our fund overall, it just doesn't reconcile with me on the kinds of things that I believe. And I'm pretty simplistic. I'm not a super complex dude on those kinds of things. I think that there is process and rigor and rubric that people follow, and as long as they're following that and are consistent with that, I think I'm okay with what people do. I don't need to see somebody else's worldview and completely agree with it, to invest with someone. But there is some element of that too. I mean, I had that when I was with Dimensional. Dimensional big premise is that markets work. And so if markets work, it was really hard for me to reconcile with somebody who said, well, markets are inefficient, that's why I'm going to go with this fund manager. I don't think you can believe both. I think that overall, there can be some anomalies and things like that, but overall markets work. Everybody that's buying and selling is doing it up there. Nobody's forcing them, and they all have the same information nowadays. And so if you're buying a stock that's going up, the guy that sells it to you thinks he's already done and he thinks it's a good trade. And if you're selling on the way down, the guy's like, man, I got rid of that one. And the other guy's like, man, this is a great value for me. So those are the kinds of things that I believe in. And so if everybody's got the right information, everybody's making those trades, I'm cool with that. I'm not so cool with kind of asymmetrical information that some people think they have or don't have and kind of put that over on others.
Yep, that makes total sense. So then diving into where you are investing, is your thesis still focused predominantly on ancillary equity funds as well as plant touching debt funds?
Yes, it is. And the reason we did that is that, if you look at each of the new markets that come into cannabis and they get approved, I mean, there's hyper growth and those initial kind of licensees, whether it's cultivation or dispensary or extraction, there's just a lot of hyper growth that comes out. But then it just kind of tails off, then you just see, we know what cap rates are for agriculture. I don't know if there's a premium on growing hops, for the alcohol industry as there is for cannabis right now, growing, flower for the industry. And so, we know what long-term cap rates are for agriculture, and it just doesn't reconcile that we'll have these crazy multiples and crazy growth on the agricultural side for cannabis forever. It just doesn't work that way. And so what I felt that, again, we're a 10-year fund. I think we're still all very early in cannabis. We're not even in an inning yet. We're still building the playing field for it. Still states that don't have it. There's still places you can't get access. I mean, look, in LA County, the city of LA doesn't allow any dispensaries, doesn't have any licenses anywhere. So that's pretty big. That's a pretty big deal. So there's still a lot of access we're still trying to get. Cannabis is not ubiquitous. I mean, it is for you and me because this is all we do every single day. But the layperson out there is like, oh, I heard about this THC or CBD thing, and that's really all they know. And so, we're nowhere near even really starting the game yet. We're really just kind of building the overall playing field. There's nothing that's ubiquitous. And so we're just trying to figure out what that's going to look like. And so I felt like that there was opportunity to just get in and figure that space out and figure out what's going to work for a wider swath of investors rather than the folks that would just really, really had the risk appetite to go into it first.
Yep, that makes total sense.
Yep.
And so then as you think about thematically, are there specific sectors that you think are maybe overheated or where a lot of managers are potentially overpaying today?
Well, I think a lot of people are paying for new licensed states. I mean, the numbers in some of those things are just outrageous. The amount of capital that has to go in to launch into a new market is really astronomical. Especially some of these limited license states. I mean, I think the numbers are public on the ones in Florida. All those licenses were upwards of 25 million each. And I think one just recently sold last year for like 45 million. You got to sell a lot of product to kind of make up for that, and that's just to get going. And you still have to build out the entire infrastructure for these states, and so, we're still yet to figure out what the model is going to be going forward. Is it going to be kind of an alcohol, beer bottler, distributor type model or things like that? What kind of model are we going to have that gets, produces and grows cannabis and distributes it to the overall market? What's that going to look like? Is it going to be decentralized? Is it going to be, an ITT kind of conglomerate and things like that? I don't think we know that yet. And so it's hard for me to look at a new market, say like Georgia, where you have to put up so much capital and so much bonded insurance to even just get going on that stuff. It's going to take a long time before that kind of comes into play. And then you have other markets like Oklahoma, where everybody gets a license. And it's really exciting until there's just so much supply that, the price just drops dramatically. So, we still have market forces work in every individual state that happens. And depending on the regulatory structure, it kind of dictates what happens after that. So I think that part is still that I see, and I still see kind of, people, in the regular community is like, oh man, I'm getting in on a license in Maryland. I'm getting in on a license in this. I'm like, I hear you, and that's exciting and all, but there's a whole lot more to the overall cannabis space.
Right.
My thing that I focus and think about a lot is really, what's that next wave? What's that next moonshot? Look, cannabis is growing at such a great growth rate right now that we're all going to do well. Our LPs are going to do well. We're all going to do well in it, because it is growing, and there's massive capital, massive, consumer demand for this product and what we're doing. But once we get past this kind of federal legalization or descheduling, or whatever it's going to be, that allows for much more wide scale research on this stuff, then we'll really see, this is going to be better for the human race. Us as a species having these cannabinoids in our systems is going to be better for us than when we didn't have it in our systems.
Yeah.
It just is. I mean, I've seen it anecdotally, you've seen it too. People that work with these products with health patients and wellness patients. I mean, they're doing some monumental things. And so, I think that we have yet to, there are people that are kind of looking at that and kind of getting to that, but it's hard to really have a market for that just yet. I mean, even just the Epidiolex with GW Pharma, those numbers were astronomical, but those guys made a bet on one small segment of that kind of health wellness space and did fantastic. So just imagine, if we have, people laugh at me when I say it, but what if we cure cancer with this stuff? What is that going to mean? What does that mean for an investor? You only need one of those in your portfolio to make it happen. And so I think that's really the next wave, and that's really why I started this fund, so I could get into the space now and really understand all the moving parts of what's going on. And so that, this fund gets launched, fund 2, fund 3, everybody's coming to me and our firm first, hey, this is what we're thinking about. And we can kind of talk about that because we've got the research right now in all the US, and soon we'll have all the research globally of all the different funds in the space and what they're doing. Say, hey, look, there's a bunch of funds that are focusing on this space, man. This is an area that, that nobody's really focusing on, but there's still a lot of high growth in that area. So we can seed some of those things. We can incubate some of those things that kind of fits into what we believe was going to happen long-term for cannabis and the cannabinoids. Cannabis is one thing that people kind of equate to THC, but I really believe that once we really broaden this out with the cannabinoids, it's just going to mean so much more to people.
So much more. And I think the other point I'd highlight on the benefits of cannabinoids, which I agree with you 100%. I also think that, frankly, there's just been so much destruction caused by the war on drugs, by the Controlled Substances Act, disproportionately, obviously impacting communities of color and really ravaging those communities, particularly over the last 50 years, as we've just seen enforcement increase and all these efforts put to criminalize people who are selling a drug that, frankly, is much more of a medicine than, a harmful drug. And so that's one of the aspects of the industry I'm most excited about as well.
And I think this industry does it or at least the only comparison I can have is my old financial services world. And there were decades, literally decades, that I was the only brown person in the room. And there was maybe 2 or 3 other women,
Mm-hmm.
And so I think that while there is still a lot of that in cannabis, at least on the financial side, there is an emphasis on it, and people are making real investments in diversity and social impact, and providing resources and guidance. There are companies that will target communities and do their market research on certain communities and really find the right people that fit in with that community to be able to be part of that community and deliver their products and services that way, in a way that's meaningful to that community. And so, and they will, much like, franchises, things like that. You go to a McDonald's in kind of inner cities or other areas, that it reflects what's going on in that community, and all the people that are working there, people that are going there, they're all look and walk and talk the same. And the same can be said for these things in cannabis. There is widespread utilization and uptake of this across all races and colors and genders and things like that. But it has been it's been too long that it's been prejudiced against people of color as far as being utilizing this stuff. And you can see that in the conviction rates of minor crimes like this, of possession of marijuana and things like that are just so onerous. But I do think the industry is doing a lot better. And I also, we talked to a lot of funds, and I don't know specifically off the top of my head, but I'd say 3 out of 5 have this as part of their PPM and their philosophy and their thesis of what they're trying to do.
Yeah.
And some don't have it, but in practice they do it. And so I think that is also really bodes well. Because you look at the broader kind of VC private equity world, there's very few. I think you can count on one hand the number of Latino-owned businesses that have received VC funding. On one hand, I know 2 of them. That's it. And yet in cannabis, that is getting, there's funds that have 4 and 5, Latino and Black-owned and Asian-owned companies inside them. So there's a lot more diversity on the cannabis side as far as the investment dollars that are in capital that are going into the industry, that are really picking out and really being determined and intentional about where the capital goes and who it goes to. So I think that's great for the industry. And we're trying to build a different kind of firm as well too. We're a minority and woman-owned firm, and we're making sure that we have specific hires that we're looking for to make sure that we look different, that we have a diversity of opinions in our overall firm, and to do that. So it's great to do that in this space. And I don't know if I could do it, and I guess I could, but I think it's easier to do it in cannabis because it's just more open. People are more open to the dialogue. People are more open to the discussion and interested in hearing about it. It's not so foreign when I kind of talk about the kind of team we're building.
Yeah, no, I think that's fantastic. And we certainly see it from our end as well. You mentioned more broadly financial services, right? And I think the stats are something like 90% of people who work in asset management or investment banking are white males, right? And it's tough because as we think about, obviously as we try to scale our company as well and bring on new people, well, naturally the first thought is, who have I worked with before that I knew was a great performer? And you think through and like, oh, that was a white male. He was another white male.
Yeah.
And then you think about, well, obviously, part of our business model, very important thing also is fundraising, right? And so think about who do we know that has access to capital? Generally, again, it's the white males. So you see it's just how the system has really been, given that relative advantage, right? Or white privilege or whatever you want to call it. And, really finding ways to make sure that we're correcting for that and doing everything we can to find great diverse candidates to come, not just to invest into, but also to come on board for Key as well. It's a really big initiative that we're working on too.
Jordan, that really resonates with me too, because, as we're building this out, all right, I'd like this type of profile. And I think back, well, the first 5 are like white male dudes, because that's what I worked with, those are great. So, you have to kind of, luckily I worked for some great firms, and like iShares was super diverse. It was the first time that I sat in a room and there were people of all shapes and sizes and colors and gender orientations and the like. And it was the San Francisco based, and the ethos around it was about culture first. The product was phenomenal, but the culture was really important, how you built that around that. And so I take a lot of learnings from that. And then I also, and then that got bought by BlackRock, which is a much larger, publicly traded company. But I got to give it to Larry Fink. I mean, Larry Fink has done a really good job of hiring, really great people from all walks of life into that firm. And I have this, I've been mulling over this kind of blog post I want to write about Larry as being one of the greatest private equity investors there is. I mean, he used the public markets, but he came out of Blackstone. He had this tiny little mortgage company that's turned into BlackRock, the largest asset manager in the world by far. And so, and it was all done by acquisition. So I've worked with some really great investors, but I think Larry's done a really good job of hiring a lot of diverse talent into his organization. And while the culture itself is not a place that I really enjoyed, overall it was a good place.
Yeah, that's great. And I think it's funny, actually, this discussion, I think, ties back nicely to how we started with regards to the limited licenses, in the sense that, I think it's certainly natural that investors would say, hey, we want to own a license in a state where it's limited. You look at Illinois, where GTI and Cresco have exploded, or states like Florida, you mentioned, where Trulieve has really been successful. But part of the trend that we're seeing and we expect to persist is that over time, we think more and more states are going to move away from the limited license to either, much more competitive licensing or uncapped altogether, and also putting more and more of an emphasis on local license ownership, on social equity ownership. And so we have the concern longer term that, the value of these limited licenses will decline over time, right? Similar to how you saw taxi medallions in New York completely erode value once Uber and Lyft came along.
Yeah, right. Yeah, those medallions used to be super valuable. I mean, like you mortgage your house to get one, and so I think I think you're exactly right. I mean, there is precedent for things like that, and so I think that's the part that people have to kind of figure out. And if you're investing in public markets, you really have to think about that, because the big MSOs are really the main ones that are trading out there, and so you have to think about what's that going to mean long term for this investment. And I think about that all the time. So if you're making a public investment right now, whether it's cannabis or anything else, are you saying, hey, I'm really excited about the unlimited upside I have in this investment? Or you're like, man, I hope I get out before this is all over.
Right.
When we're on the private side, you're like, man, I'm really excited about the unlimited upside I have in this company. I'm excited about the exits that could come, the acquisitions that could come, the growth itself that it could come. And it's not Pollyanna. I'm not just kind of like talking my book. It's just a reality that we see right now in the private markets in cannabis, the one that I know the most, that is the reality. There is unlimited upside for a lot of these companies. And I think it's a great investment for right now.
Absolutely. So then on that front, Cato, are there other sectors that you're seeing as maybe a little bit unloved or forgotten about by fund managers that you think they should be paying more attention to today?
Well, it's part and parcel of that discussion about the sexy names and the sizzle and some of those names that people are coming into. People, there is a lot less in the seed stage right now, in the true kind of VC seed stage in cannabis right now. There's the players that are there are they're smaller by design because they're writing smaller checks, but there's a lot less of those right now. If we look at our overall universe, I mean, half of it's kind of this growth kind of PE stage right now. That's kind of where most of the money is and most of the investors are coming from. And there's very few in kind of dealing with the seed stage. And I get it. I understand. We're all trying to deliver for our LPs and that kind of record, but as a fund of funds, we're trying to make sure we're diversified across all these sectors.
Sure. And
I really feel like the seed stage is an area that requires a hearty stomach. I mean, it really does. It wasn't for me. It wasn't something that I was really comfortable doing. But there are plenty of great managers that really have great analysts and analyst teams to be able to do that. But I think that's the area that we're really lacking. And we'll see how that plays out, how that unfolds, as we go longer into this economy and this tenure of what that means as far as growth for some of those companies. I believe that it's just going to mean that some of those that survive and grow are just the best companies out there. And so we'll see how it goes.
Yep. Well, we'll see how it goes.
Yeah.
And so I'm curious, how do you think that, over call it maybe the next 1 to 3 years, the capital markets landscape is going to develop? Do you expect to see more institutional investors come into the market, or do you think that there's still going to be a little bit of a barrier to entry to the existing cannabis funds in the market?
Man, that's an interesting question, because the common wisdom out there is like, oh, once it's legalized, everybody's coming in. And I'll just give you an example. I've worked in and around Latin America my whole career, working for the largest asset managers, Fidelity, Putnam, iShares, and BlackRock, and Dimensional. There are thousands of mutual fund and ETF companies out there. There's only hundreds that are in Latin America, that invest in Latin America, that have operations in Latin America. They may all have emerging market funds or Latin America funds that, pick companies in those. But as far as having an operational institutional presence in those markets, there's so many that don't. And that's really just kind of bias or prejudice or knowing the market and things like that. I think it's going to be the same thing in cannabis. There's some deep-seated prejudice, not a negative, just an overall bias against it for some that they may never get over. And the other thing too is that if you're not actively kind of looking at it right now, you're still looking at it from a lay perspective, like, well, it's all grows and dispensaries and things like that. And so it's going to take a while for that to play out. I do believe it's additive to the overall industry because it's just more capital and valuations grow and things like that. And so we're all the rising tide lifts all boats. But I don't know if it's going to be this wholesale shift where you flip the switch and everybody's in, because like I said, that there's still plenty of companies that don't have any presence in Latin America, and not because there's not money there. It's because there's just some bias against it, or a knowledge or lack of information or knowledge about those markets. And that may be the case in cannabis as well too, that maybe people say, well, I'm doing just fine with what I'm doing here. There's really no need to go into this space. It still has all these, things about it, these negative biases and prejudices about it that may not happen. I think there's going to be more capital when it comes in. But as far as a wholesale shift, like everybody's in cannabis, I don't think that's going to happen like that.
Yeah, I think that's absolutely right. And, the stigma you're talking about is really unfortunate part of the industry, but it is a huge impact. It really is. And it has certainly dissipated over time. And I think it will continue to do so, but there still is, 50 years of people being told this is an evil drug that'll make you crazy and you should go to jail forever, right? That's not something you just unwind overnight.
No, at all. And look, I talk to folks all over the country, and then all over Latin America too. But I don't get the in Texas specifically when I talk to either potential LPs or just former colleagues and friends there. Texas is the only place people ask me about the cartels. I can talk to LA, talk to New York, I can talk to Colombia. Nobody asks about the cartels, but I talk to folks in Texas. It's not everybody, but that's the only place that every time I was talking about this fund, what we're doing, well, what about the cartels? What are they going to do? I'm like, I don't know. Maybe they'll get a license. I don't know. We'll see. But so that's still out there. But it's just funny to me that Texas has been literally the only place that people ask me about it.
Yeah, that is really funny.
Yeah.
And the other thing I think we'll see as a hurdle to a lot of traditional institutional investors is, one, you've got a lot of them have vice clause restrictions, which their limited partners say, you can't invest in any quote unquote sin industry like tobacco or alcohol, firearms, and we can go down the whole rabbit hole of should cannabis even be considered a sin when it's clearly got medicinal applications. There's no ESG issues with investing in firms like Coca-Cola and Frito-Lay's, right? So anyway, I think that's still going to be an issue that persists, as well as the fact that, I think a lot of folks will view it as not necessarily an ESG friendly industry, which again, I would argue is probably not the right way to look at it, but is frankly going to be probably the default that most folks think about. So I do think, to your point, there's probably going to be still quite a moat from a lot of these traditional institutional investors from jumping into cannabis.
Absolutely. I've talked to folks at Blackstone and others, and that the same kind of deal. It's like their view, and nothing against them. They're really smart people, and they're doing really great things, but their views on cannabis is limited, and you have to really kind of be in the space to kind of get a sense of it and understand what's really going on. And the more I get into it, the more, I'm just excited about it. Every manager that I talk to that are new in the space or been there for a while, this is a great place for investors, and it's a great place for people to generate, outsized returns for themselves and for their LPs, because it's just growing like crazy. And folks like you and others that come from other, the mainstream kind of VC and private equity world, everybody I talked to in that space is like, yeah, this is great. This is a great space to be in. We're valuations are still really good. We've got companies that are really growing in an absolutely onerous regulatory and taxation regime. Every state, every municipality is different, and they're still growing. I mean, the industry grew 52% last year in a pandemic. I mean,
yeah,
it's a good spot. It's a good spot to be in.
Absolutely. Great spot to be in.
Yeah.
Great. Well, Cato, thank you so much for taking the time to have this conversation this morning. This was so fun for me. For our listeners, if they want to get in touch with you or learn more about ways to partner with Hoja Capital, is there a way they can reach you?
Yeah, the easiest way to reach me is just on LinkedIn. I check that religiously. I meet a lot of folks through LinkedIn. And so it's just Cato Felan at LinkedIn. And I'd love to, chat and talk to folks. And, I do lots of Zooms all day. So happy to include people in that.
Fantastic. Well, now that folks are getting fully vaccinated, feels like travel's opening a little bit back up. So hopefully we can do an in-person meeting here soon.
I'm excited. I was excited to meet Colby a couple of weeks ago in Austin when I was there. That was a great time. Yeah, it was good.
Fantastic. Awesome.
Yeah.
Well, Cato, thanks so
Jordan.
much again.
Thanks for
this was a blast, and let's definitely do another one sometime.
Sounds good. Thanks, Jordan.
Take care.
Take care.